You've probably heard that the S&P 500 is the best place to build wealth. But what if I told you it's a one-trick pony that leaves you more exposed than you realize? In the 2020 crash, the index dropped almost 35%, dragging millions of investors into panic mode. That's why today I'm going to show you a smarter, data-driven upgrade. A 5 ETF portfolio built from VOO, SCHD, VBR, VEA, and XCEM. By the end, you'll see how these 5 funds can be arranged into 3 practical portfolios tailored to different life stages. But first, we need to talk about the hidden weakness inside the S&P 500 itself. Roughly 1/3 of the S&P 500's value is concentrated in just its top 10 holdings, about 34%. That means an index that appears broad and diversified is often moving in lockstep with only a handful of giants, mostly in technology. When Apple, Microsoft, or Nvidia surge, the whole index is pulled higher. But when those same firms stumble, the impact drags down the fund with surprising force. It's like driving a sports car with massive horsepower, but without a reliable braking system. It feels powerful when the road is smooth, but one unexpected turn can expose how fragile the setup really is. This is why the S&P 500 isn't a truly balanced exposure many assume it to be. On the surface, holding an S&P fund looks like owning hundreds of companies across industries. That's why it's popular in 401k plans and retirement accounts. It's simple, cost-efficient, and has crushed most active managers over decades. Yet, beneath that surface, the performance of healthcare, energy, or consumer goods plays a smaller role than you'd guess. For most investors, they're not buying the whole US economy. They're buying the fate of a few firms so large they steer the entire index. When times are good, this concentration provides an illusion of stability. Strong earnings from 1 or 2 big companies can mask weaknesses elsewhere. But downturns reveal how exposed you truly are. In 2020, as pandemic fears hit, large tech names fell sharply, pulling the broader index down with them. People who thought they had safe spread out exposure realized they were tied, often unknowingly, to a concentrated group with no real ballast elsewhere. This concentration issue doesn't only show up in short-term volatility, it also weighs on long-term resilience. Academic studies have pointed out that portfolios dominated by a few winners can perform impressively for a while, but in the long run, the lack of diversification reduces their ability to bounce back consistently. Resilience isn't about beating the market in one good year. It's about smoothing returns across unpredictable cycles and not depending entirely on one narrow engine of growth. And here's something else to consider. The S&P 500 carries what's known as home bias. By sticking exclusively to US firms, you automatically miss opportunities abroad. Over the last decade, US stocks materially outperform many developed and emerging markets, creating valuation gaps elsewhere. Some economies and industries outside the US are priced more reasonably and may capture future growth that won't show up in the US-only portfolio. Ignoring them means accepting blind spots, even though the global economy rarely moves in perfect sync. So the question becomes, how do you keep access to the undeniable growth of large-cap US stocks while protecting yourself from both concentration risk and home bias? Is there a way to hold onto the strengths of the index while building instability, balance, and global growth drivers it lacks? That's the multi-asset Swiss Army knife approach we'll build next. Instead of leaning on a single fund with built-in weaknesses, we'll combine 5 ETFs designed to complement one another and fill the gaps the S&P 500 leave behind. If one ETF is like shifting into a single gear on a bike, what happens when you add multiple gears, each calibrated for a different type of terrain? Suddenly, you're not locked onto one speed. You've got flexibility. That's the logic behind the 5 engines of this upgrade. Instead of betting on one fund to perform in every condition, each ETF in the lineup plays a distinct role. And while 5 funds may sound like a lot, once you've seen what each one does, the structure is straightforward. Each piece has a clear job. Let's begin with VOO. the portfolio's core engine. VOO gives you direct exposure to America's largest and most influential companies, the S&P 500 itself. This is where you'll find the heavyweights: Apple, Microsoft, Nvidia, firms that shape the entire US market. It captures the long-term growth story of corporate America, but it's also top-heavy, with technology making up a big slice of the index. That concentration carries risk, but it also ensures you're not missing the powerhouse companies driving US innovation. One reason VOO is so widely held is its ultra-low expense ratio of 0.03%, which makes it a cost-effective core that's tough to beat for efficiency. Of course, growth alone can be a rough ride, which is why SCHD steps in as a stabilizer. SCHD focuses on companies with a record of returning cash to shareholders. To even qualify, a company must have at least 10 consecutive years of dividend payments, and the fund further screens for quality factors like profitability and financial strength. Its expense ratio is only 0.06%, and its holdings tilt towards well-capitalized blue chips like PepsiCo and Coca-Cola. These aren't the flashiest stocks, but they provide steady income. Those dividend checks give investors reassurance during downturns, offsetting some of the market's emotional drag. SCHD won't erase volatility, but it cushions the impact. Next comes VBR, which plays a very different role. This is the small cap value fund, holding nearly 800 of America's under-the-radar businesses. Like VOO, where the top 10 stocks dominate, VBR spreads out broadly. Its top 10 names make up less than 6% of the portfolio. That means no single company can sink it. Instead, the fund leans on entire sectors, with financials and industrials taking leading weights. Historically, small cap value has delivered some of the strongest long-run returns, though with more bumps along the way. Including VBR injects a contrarian element into the mix, companies overlooked by most investors but carry hidden growth potential. Up to this point, we've been in the United States, but limiting yourself to one country ignores the broader global economy. That's where VEA enters as the global competitor. It gives you exposure to developed markets beyond the US. Think Europe, Japan, and Australia. These regions move through different cycles and often trade at cheaper valuations than American stocks. That difference matters. When the US slows down, other economies can sometimes step in with stronger results. Adding VEA spreads risk across borders, so you're not overexposed to US-centric market swings. Finally, we come to XCEM, the Emerging Markets ex-China ETF. Many funds in this category are dominated by China, tying performance tightly to one country's political and economic policy shifts. XCEM solves that problem by excluding China and focusing instead on economies like India at roughly 27%, Taiwan at 26%, and South Korea at 14%. Its top holdings, Taiwan Semiconductor Manufacturing Company, makes up about 13% of the fund. That concentration captures some of the world's most important growth engines, from India's expanding consumer base to Taiwan's dominance in advanced semiconductors. It's the most volatile gear in the lineup, but it also comes with one explosive long-term potential if these economies continue scaling. Together, these 5 funds give you exposure that no single index fund can offer on its own. You've got the US giants with VOO, the dividend-paying stabilizers of SCHD, the overlooked growth of VBR, the global reach of VEA, and the emerging strength of XCEM. Each plays a different part, and when combined, they support one another in a way that balances growth with resilience. But here's a catch. Even with all 5 engines in place, the right balance depends on you. What works for a young investor just starting out may be completely wrong for someone preparing for retirement. And that's where the real strategy begins, reshaping this lineup to fit the stages of life you're in. At different points in life, your portfolio shouldn't look the same. That's the essence of building portfolios by life stage, shaping the same 5 ETFs lineup into different blends depending on your goals, your tolerance for volatility, and how much time you have before you need the money. The power of this approach is flexibility. The funds stay the same, but the recipe changes as you move from growth to balance to preservation. Let's start with the young accumulator. This portfolio is for someone in their 20s or early 30s, just beginning to build wealth with decades ahead. The allocation looks like this: 40% VOO for broad US large cap exposure, 25% VEA for international developed markets, 20% VBR for small cap value, and 15% XCEM for emerging markets outside of China. The aggressive tilt works here because decades of compounding provide room to ride out cycles in VBR and XCEM. Expect big swings. VBR lost around 45% during the 2020s crash, and XCEM carries both higher expenses, 0.16%, and more volatility than developed markets. But at this stage, risk translates into potential growth, and time is your parachute. Next comes the balanced grower, which fits best for investors in their 40s or 50s. At this point, retirement isn't immediate, but it's no longer distant either. The recipe shifts towards greater balance: 40% VOO for steady US growth, 25% SCHD for dividends and a defensive anchor, 20% VEA for developed market diversification, 10% VBR for continued small cap exposure, and just 5% XCEM to keep a foothold in emerging markets while reducing risk. This setup still leaves plenty of room for compounding, but it removes the sharpest edges by leaning on SCHD stability and trimming back the riskiest holdings. The rationale is straightforward. Less time to recover from big downturns means less exposure to volatility without sacrificing diversification. Finally, there's the capital preserver, the allocation for someone entering retirement or already there. Here, the priority is protecting wealth and creating reliable income streams rather than pushing for maximum growth. The mix looks like this: 60% SCHD to maximize dividends and stability, 20% VOO for continued US exposure, 15% VEA for international diversification, and 5% VBR to maintain a small touch of value-driven growth. Notice XCEM disappears entirely. The swings in emerging markets are simply too sharp for someone relying on their portfolio for income. And research shows that at this stage, stability matters most. The portfolio shifts heavily to SCHD because dividends not only provide cash flow, but also help soften the psychological blow of downturns. And that psychological factor matters. Imagine being 25 and watching your portfolio fall 40% in a crash. It's painful, but time gives you confidence to wait for recovery. In contrast, a retiree facing the same downturn while depending on their nest egg for daily expenses could panic, sell at the wrong moment, and lock in lasting damage. That's why dividends at this later stage are so valuable. They provide tangible income even when markets are sliding, giving retirees breathing room to stay the course. The key takeaway is that the same 5 ETFs can morph into entirely different strategies simply by adjusting proportions. You don't need more funds, just different blends for each stage of life. The young accumulator pushes hard into growth. The balanced grower trims volatility while still compounding. And the capital preserver prioritizes predictable income and stability. Each approach acknowledges not just your financial horizon, but your emotional tolerance for risk as well. This adaptability is exactly what makes the 5 ETF system compelling. But acknowledging its flexibility doesn't mean it eliminates every weakness. Even the most carefully designed mix carries trade-offs and blind spots that show up in real-world crashes and recoveries. So, is this carefully structured 5 ETF portfolio the perfect solution? That's the question worth asking before giving it that label. Many people equate diversification with guaranteed safety, but that's never the case. Diversification spreads risk across sectors, regions, and factors. It doesn't erase it. Each ETF in this mix still carries unique weaknesses. Combining them balances those risks, but balance isn't the same as invincibility. Take VOO, the US Large Cap Core. It delivers exposure to America's biggest and most influential companies, the ones that dominate headlines and indices. But that exposure also comes with sector concentration, especially in technology. When companies like Apple, Microsoft, or Nvidia soar, VOO lifts the portfolio. When tech struggles, whether from interest rate hikes, regulations, or slower innovation, the same concentration becomes a liability. Many assume an S&P style fund is automatically diversified because it holds hundreds of names, but in reality, a handful of giants steer much of the performance. Now, look at VBR. Historically, small cap value has been one of the strongest returning factors, but it's also one of the choppiest. In the 2020 crash, VBR fell about 45% from peak to trough, one of the sharpest drops among all equity styles at that time. Smaller firms lack the safety net of multinationals, fewer cash reserves, limited global reach, greater resilience on credit. That combination makes them highly sensitive during recessions. Owning VBR means you accept those intense swings in hopes of stronger long-term payoffs, which require both patience and a steady hand. XCEM is another piece that looks powerful but introduces its own risk. It focuses on emerging markets outside of China, spread heavily across India at about 27%, Taiwan at roughly 26%, and South Korea at around 14%. Its top holding, Taiwan Semiconductor Manufacturing Company, makes up about 13% of the fund, reflecting the dominant role of semiconductors in driving growth. But growth comes with uncertainty. Political friction, trade disputes, and currency fluctuations often amplify swings. XCEM also charges a higher expense ratio of 0.16%, adding to the cost of exposure. It offers access to economies with strong long-term potential, but you pay for that potential with both volatility and unpredictability. Then there is VEA, the Developed International Fund. Its role is to reduce home bias by allocating beyond the US, a principle supported by decades of academic research. Still, international developed markets have lagged behind American stocks for a long time. Over the past 10 years, VEA's compound annual growth was about 6.8%, noticeably lower than US performance over the same period. The value shows up in diversification and mean reversion, but the catch is patience. Investors may sit through long stretches of underperformance before seeing that benefit. Contrast that with SCHD, designed around dividend payers with consistent track records. During the 2020 downturn, while funds like VBR saw steep slides, SCHD's companies kept delivering shareholder payouts. The fund's 10-year CAGR sits at 11.18%, showing it's not just about income. It has combined stability with long-term growth. That dividend stream is as much a psychological anchor as it is a financial one, helping investors stay invested when markets turn rough. For many, this steady flow of cash can be the difference between holding the course or panic selling at the worst possible time. Taken together, these ETFs don't eliminate the downsides of investing, but they do spread your exposure across different engines. At times, VOO will lead. In other stretches, SCHD's dividend cushions return. Some years, it might be VBR or XCEM giving the surprise boost, while VEA provides ballast through international diversification. The strength lies not in perfection, but in the interplay, multiple paths working together so no one single weakness dominates a portfolio. So, does the perfect portfolio truly exist? Probably not. Not if your definition of perfect means never losing money, never facing volatility, or always outperforming. But if you define perfect as a system that blends growth, stability, and global reach in a way that can adapt to different life stages, then this 5 ETF design comes close. It doesn't pretend to avoid every storm. Instead, it provides a framework to endure them, a toolkit that's flexible enough to last through cycles. And that brings us to the larger question. If a single fund isn't flawless and a balanced system requires trade-offs, how do you decide what to lean on most? That choice is at the heart of why investors debate the role of the S&P 500 as a standalone solution. A single S&P 500 fund is powerful. It captures American growth like few other tools. But relying on it alone is like running with one strong engine and no backup system. Markets shift constantly, and what works in your 20s won't necessarily work when you're nearing retirement. Which of the 3 recipes matches your stage? Growth, balanced, or protector? Tell me which and why in the comments. And if you want more data-driven portfolio guides, like and subscribe. Next, we'll simulate those mixes through past crises to see how they held up. The 5 ETF system gives you multiple pathways to win, not a perfect shield against losses, but a more resilient, multi-factor way to build wealth over time.